All right, in today's tax lesson, we're going to take it from kind of the general big idea to what does this mean for an individual taxpayer or a household? So you might be filing by yourself or you might be filing with someone that you're married to. Those are pretty much the two main situations. So, how taxes are calculated. First, we're going to take all of your income and add it together. And that becomes what's called gross income. And this could be money that you make from anywhere. So it could be your investments that you sold, a business that you started and you're making money off of, wages from a job. It could be a lot of different things, and they all get kind of pulled together into what's called gross income. Gross usually means before anything is changed. Then, for tax purposes, they're going to take a couple of things off of that, and so you owe a little bit less in taxes. So our second step is called the adjusted gross income. And that's when they take the gross income and then they give you a few things that you can subtract from it. And these are things like retirement savings, certain education expenses, and moving expenses. So if you have to move from one place to another for a job, you can actually take some of that off of your tax burden, which is cool. Retirement savings, we've talked about how it's a good thing. And the government kind of rewards that by letting you take that out of how much you owe for taxes. All right, so now you kind of have your money minus these deductions. And then we go into phase 3, which is where you actually figure out your taxable income. And this means that there are a few more deductions that you're allowed to take off, or you can use what's called the standard deduction. So a few years ago, there was a bill that changed the standard deductions amount, and it made it quite large. And so they're predicting that only 12% of people are not going to be using the standard deduction based off of this new amount. So what this means for you is basically you're almost certainly going to be using what's called the standard deduction. But if you start doing TurboTax or something to prepare your tax forms, they're going to ask you a ton of questions. You're going to feel a little bit like you're being interrogated. They have a question for everything, like, are you blind? Are you elderly? Did you contribute to the hurricane disaster in 2016? Like, they want to know every little place that you might be able to save on your taxes. And so you're going to end up answering a lot of questions from the itemized list just so they can compare to this number, which for 2020 is going to be $12,400. If the amount for the itemized list is bigger, or you would save more by going through that checklist, then you're going to itemize and they'll just prepare it with those individual deductions or subtractions versus the standard deduction where they just take like that exact number as the amount that's coming off. So basically, if you made, let's say, $40,000 as your adjusted gross income, they're going to be taking this standard deduction or the amount from your itemizing, and then that becomes how much your taxable income. That's the number that's going to be compared to the charts to determine how much you owe in taxes. So the last step is they're going to base their calculations on the percentages that you owe at different brackets. And we'll talk about that more in our next lesson, where we actually learn to calculate some of these tax amounts. And then you can apply for tax credits. So let's say you owe $1,200 in taxes. If you have dependents, that's like kids, or if you end up supporting your parents later in their lives, or if you make very, very little money, and they have something called the earned income credit, This is also adjusted if you have kids, like if you end up as a single parent or something. The earned income credit takes into account who you are supporting, which is kind of nice. And if you're going to college, there are a few tuition related ones. So they actually have two, the lifetime learning and the, I forgot the names. Anyways, they reduce the amount of taxes that you owe. So it's a credit because it credits you for some of the taxes that you would have had to pay. Now, the reality is you've been paying taxes all year at this point, and we're actually in the next year when we calculate these things. So you've already paid taxes for the entire year. And really what we're going to do is we're going to figure out, did you pay enough or did you overpay? Because that's also a very common situation. And you kind of fall into one of these two categories. Very few people pay exactly the right amount. So if you overpaid, the government's going to send you that tax refund. That's the check you get in the mail with some of the money that you had overpaid to the government. If you underpaid, then you owe the money and you have to send a check to the government for the right amount. If you don't pay those taxes, we talked a little bit about what might happen in the last lesson. But remember, there were also ways to work with the government to create a payment schedule if you can't pay it. Anyways, it's better. Some people consider it better to overpay so that you have this nice, happy moment where you get a big, fat check in the mail. And other people think that, you don't want to be lending the government your money when you actually need it throughout the year. So that's up to you. But here is the main process. If you want to know a little bit more about maybe some of the things you might itemize for, or some of the tax credits you heard about, you can Google them, or you have a link in the assignment that has the original article I worked off of. So happy reading.